so efficient market hypothesis. Basically, Marquise Kendall didn't find any pattern in stock price changes because they're random. So prices are likely to go up as they go down a particular day. So how do we explain these changes? So efficient market hypothesis says that stock price already reflects upon all the information available. So a forecast about favorable future performance market, participants trade on new information, generates favorable current performance, prices change until expected returns are commensurate with risk.
Are you going to read through all the slides?
No, I didn't know what that meant. Really.
Okay, I'm just saying that, you know, try to study these presentations so you can talk from them. Okay.
So all the new information that is given is unpredictable. It won't really tell you if the price is going to go up or down. And stock prices are random, as we know. This chart shows the cumulative abnormal returns before takeover attempts. I guess this means when.
So what happens is information starts to leak.
Yeah.
Right before the announcement, and then you get a jump in the return once the announcement's done. But you can see that there is some strong form efficiency there because the information is being leaked prior to the merger announcement.
And I had no idea what this one was. Sorry.
Hmm?
This is like the CNBC report, and it was showing like it was like this reaction to the reports, but I don't know what the positive and negative, like what the difference was.
It's probably two.
Like this shows like the differential that's between after the information was given.
Well, one could be the target could be the one on the top, and then the acquirer would be on the bottom. So if I'm taking over a firm, I announce a merger, the target company stock price is going to go up and the acquirer stock price is going to go down. Because there's money being exchanged.
Wouldn't it be the other one?
No, the target company's stock price is going to go up after the merger announcement. And then the acquirer,
yeah,
the one who's buying it, their stock price could, exactly, potential dilution, exactly.
So as long as we have strong competition, stock prices are going to be more accurate. So higher investment returns motivates information gathering. Sorry, I have to read all this out because it's very confusing to me, honestly.
Yeah, again, you got to kind of study it before you.
I was looking at this for a while and I couldn't get it last night, but.
Yeah, usually you want to probably start these things out the night before.
Okay, so versions of the EMH, the weak form hypothesis, strong stock prices already reflect altered information that can be derived by examining market trading data such as history of past prices, trading volume, and short interest. Semi-strong form hypothesis, all publicly available information regarding the prospects of a firm must be reflected already in the stock price. Such information includes, in addition to past prices, fundamental data on the firm's product line, quality of management, balance sheet composition, patents held, earnings forecasts, and accounting practices. And the strong hypothesis is that stock prices reflect all the information in the firm, even insider information. So the technical analysis of EMH, using the prices and volumes to predict the stock price. Success depends on the sluggish response of stock prices to supply and demand factors. Weak form of efficiency. And that the fundamental analysis is using the stock firms using economic and accounting information to predict prices. Usually firms are mispriced because you can find how poorly run firms, you can sort of find the firms that are poorly run compared with the market thinks. And this is semi-strong form efficiency and fundamental analysis.
Now, are you reading the chapters before you make these presentations?
I go over like the little summary part in the back of the chapter. I didn't go fully through it.
You guys might want to read the chapters.
So active versus passive management. So active management would be expensive strategy and suitable for larger portfolios. Passive management is no attempt to outsmart the market. Accepts EMH, index funds and ETFs, and it's lower cost. So market efficiency and portfolio management, even if the market is efficient, a rule exists for portfolio management, diversification, appropriate risk level, and tax considerations.
Okay, so as he just went over the market efficiency and the portfolio management, they're often the reason for systematic resource misallocation, or the result of the reasoning that there are inefficient markets is because of systematic resource misallocation. And that can come in the form of either the overvalued securities, undervalued securities, or unequal, like the efficient market does not come out to the perfect foresight market. Go to event studies. Should I just go over this one? Okay, and so we can analyze this through event studies, which is just financial research done across the board to assess the impact of an event on a firm's stock price, whether that be the buying of, the selling of, the merging of. Any abnormal return due to this event is the difference between the stock's actual return and a proxy for the stock's return in the absence of the event. So you're just comparing hypotheticals to actuals. These tests are they're structured to determine whether the returns are adjusted if they are abnormal, whether that's through expected return or abnormal return, and you use these, which are just using the average rate of return, the market's rate of return during that period, the stock's sensitivity, and the part of the stock's return resulting from the firm's specific events. That's basically what both those expected and abnormal formulas are adjusting for. To determine whether or not the markets are efficient, we go to the magnitude issue, the selection bias issue, and the lucky event issue. Lucky event issue being for every big winner, there may be many big losers, but we never hear of those managers. The winners turn up in the Wall Street Journal because they're the ones that are blowing success through the roof. The selection bias issue is only unsuccessful investment schemes are made public, good schemes remain private. That's just kind of the story with everyday media. I mean, people tend to either flock towards news that's great or really bad. You don't hear about the middleman. And then the magnitude issue, only managers of large portfolios can earn enough trading profits to make exploitation of minor mispricing worth the effort, which is always true. Weak form tests is one of the weak form tests is the momentum effect, which reviews the return over the short horizon. Could be good or bad in the recent performance, and it continues over short to intermediate time horizons. The reversal effect is over the long horizon, in which losers rebound and winners fade back, suggesting that the stock market overreacts to relevant news. predictors of these broad market returns include the FAMA in French, Campbell and Schiller, Keem and Stambaugh. Keem and Stambaugh are the bond spreads that can predict market returns. Campbell and Schiller earnings yield can predict market returns, and the FAMA in French where the aggregate returns are higher with higher dividend ratios.
And it's FAMA.
FAMA. Now we have the semi-strong tests, the small firm anomaly. As you see, we have this graph that shows the annual return to the size of the firm. So it's just small firm effect, a theory that holds that smaller firms or those companies with a small market capitalization outperform larger companies.
So let's do a test question on that. Why?
Yeah.
Why would small firms annual returns be higher? A test question.
Because
Why would small firms returns be higher
it's
compared to mid or large cap? Go ahead. I'm sorry.
because their percentage is like a smaller sample size, so those returns are going to be large. That's not the best way of putting it, but
Let me try the question again.
okay.
Okay. From a fundamental analysis standpoint, why would smaller firms' annual returns be higher than mid cap and large cap?
Growing faster?
Exactly. And how do they grow faster? What do they need to do to grow faster? How can they grow faster?
Increase in value?
How do you grow the firm?
Expand the market, sell more
Yeah, but how do you finance it?
loans or investments?
How do small firms finance their growth?
Trying to go public or trying to angel investors?
No, you're going, no, just how do most small firms finance their growth?
Selling equity?
No. That's the most expensive form to
Through their
finance.
product?
What's the cheapest form of capital for a smaller firm?
Debt financing?
It's the second. What's the cheapest?
Get a loan?
That's expensive too. How do small firms finance their organic growth?
Profits from the previous year?
Yeah, what's that called? What do you do with the profits? What do you do with the earnings?
Invest it back in reinvestment.
What do you do?
Invest it back into the company?
Yeah, and that's called,
Reinvestment.
no, but what is it called when you do something with the earnings? What do you do to the earnings? What is it? It's on the, it's on your balance sheet. Do small companies retain earnings? Yes, no, no,
Yes.
Yes.
yes. Do they pay dividends in most cases?
No.
No. So they retain the earnings, the retention ratio?
It's high.
The retained earnings is the cheapest source of capital. They're gonna plow it back into the company to then grow. That's one of the reasons why small firms grow faster. One, not only are they smaller, but they're coming off of a smaller base, okay, which is gonna cause the growth rates and the annual returns to be a lot higher, and they're plowing back all of their retained earnings into working capital to grow the firm using the cheapest source of capital. Then they're gonna go, probably get the loans, then they may get, if they qualify for the loans, and then they're probably gonna go get the equity, which is really expensive, and then they're probably gonna issue debt once they can actually have recurring cash flows that can support debt issues. Okay, go ahead.
So the book to market anomaly is used to find the value of a company by comparing the book value of a firm to its market value. So that's what this graph displays, is the annual return to the book to market. That's all. I didn't really understand this graph, to be honest. It was like, I didn't know what it was trying to prove in regards to the anomaly. It was just like,
It's basically a return on cost, because your book value is a cost,
mm,
right? It's a historical cost, divided by the market. Okay, so what you're really
Okay.
doing is it's a return, it's like a Tobin's cube is what it's like from economics. So it's basically it's a return on cost. Is what
Okay.
it is.
Here we have the drift anomaly, which is the tendency for stocks' cumulative abnormal returns to drift to the direction of an earnings surprise for several weeks following an earnings announcement, which is really common. Every time a company releases a positive earnings, you're normally going to see that company drift towards whatever way those earnings compelled. And that's exactly what this graph is depicting.
This is probably one of the more important rationales that you can use in your equity sim right now that we're in earnings season. So if you're on top of your stocks and get the dates in which their earnings announcements are going to come out, or any pre-releases prior to the earnings announcements.
Where would you look for that?
You probably have to go up to the company websites.
Okay.
And so you'll have to go up to 25, and if you go to the investor relations section, it'll tell you when the earnings conference call is going to be.
Okay.
And if you're smart, you would be listening in on the earnings conference call and any pre-press releases from the earnings call, and then start making your trades as you're listening to the earnings call to see if they met or beat, the earnings expectations, the earnings projections.
Is that public for all?
Yes,
Really?
yes. Yep. So I mean, that's what I would be all over right now,
Yeah.
as trading rationale leading up to these earnings announcements, these earnings calls, because we're in earnings season. So this is the perfect time to be trading.
And that'll be up until like mid-November, right?
Usually right now, you're probably gonna start seeing some earnings, because it's already, a week after the end of the quarter. But over the next 3 weeks, 3 to 4 weeks, you're gonna get a flurry of them, and then there's gonna be a ton of them. And I would be trading all over that stuff. I'd be all over that stuff.
Okay. The second last semi-strong test is the anomalies, which is the price to earnings effect. Involves the price to earnings effect that portfolios with low price to earnings stock exhibit higher average risk adjusted returns than those with high price to earning stocks. That's pretty straightforward. Neglected firm effect and liquidity effects. The phenomenon of lesser known firms producing abnormally high returns on their stocks. So that was like, I think that's a pretty example of like the dot-com bubble back in like the early 2000s, where it was a lot of that, where none of those firms had a ton of liquidity, but yeah.
A lot of the smaller firms, or those companies, are not followed by analysts. As the firms get larger and issue more equity and become more popular, then there's going to be more equity analysts that will start to follow it. But in the initial stage, you may have one analyst that's following the stock. And as more analysts start to follow it, then you're going to get these liquidity effects.
Okay, so you're talking about for the bigger firms.
As you go from, neglected, and then you start moving into starting to get monitored and picked up by the analysts and covered, you're going to get a wealth effect. Because more information and more analysis is coming into the stock. And then the ones with the high PEs, that makes sense, right? Because if companies have high PEs, are the stocks overvalued in most cases or undervalued? Overvalued, okay? And high PE stocks means that there's high growth potential for those stocks, but if they have high PEs, they're probably overvalued in a lot of cases.
So what you're saying here
They're already
is
peaked,
that,
the prices are already peaked out.
so what you're saying here is kind of that the neglected firm effect kind of results in the liquidity effect as well.
Yeah, information and liquidity effect
Yeah.
as they start to become monitored.
Okay.
And then the high PE stocks are probably extremely priced because they're hyper growth stocks, but in most cases, stocks with very high PEs are probably overpriced. And then the ones that have low PEs, they're going to revert to the mean. So the ones that are low, they're probably oversold.
And the ones way up are going to fall back.
They're probably overbought.
Gotcha.
So for insider information, the last four names, Jack their own studies on the ability of insiders to trade profitably, and the SEC requires that all insiders register their trading activity. As for interpreting anomalies, the most puzzling anomalies are price earnings, small firm, market to book, momentum, and long-term reversal, and some of these Evan talks about. Fama and French argue that these effects can be explained by risk premiums, while 3 other people argue that the effects are evidence of inefficient markets. And so looking at this graph for GDP growth, if you look at it, all the positive values, so anything that is in blue means that the portfolio did better in years prior, and then obviously the opposite for the rest of them, but there's a couple of countries on there. Take a look. Interpreting of the evidence, anomalies or data mining. So some anomalies have disappeared, both market size and momentum, and then anomalies over time. Exploiting them eliminates abnormal profits. And moving on, bubbles and market efficiency. So prices appear to differ from intrinsic values, and bubbles are also difficult to predict and exploit. For stock market analysts, some analysts tend to add value, but it's kind of difficult to separate effects of new information from changes in investor demand. And these findings end up potentially leading to things that are too expensive to fund and to exploit as well. For mutual fund performance, the conventional performance benchmark has 2 different factors. The first factor is the 3 Fama French factor, and that means that the return on market index and returns to portfolios are based on size, and the book to market ratio that we talked about earlier. And the momentum factor is a portfolio construction based on prior year stock return. So if you take a look at this graph, it talks about the mutual fund alpha is computed using the 4-factor model of expected return. So you just see all the percentages for all the different alphas. And then for consistency, alphas are positive before fees and negative after, according to Cowher. And then for Bolin and Boos, support for performance persistence over short time horizons. And then lastly, for Burke and Green, skilled managers will attract new funds until the cost of managing those extra funds and the alphas drive down to 0. And then if you take a look at this, this is the risk-adjusted performance in ranking quarter and following quarter. So the ranking quarter is the line in blue, and the post-ranking quarter is the line in black. It's just looking at the different risk performances for the 2 quarters. So are markets efficient? Professional manager performance is broadly consistent with market efficiency. Most managers do not do better than the passive strategy, although there are some notable superstars, and those are Lynch, Buffett, Templeton, and Gabelli.
Great, thank you. So you guys are in a pretty exciting time period. Now you can exploit some of these market anomalies. You can data mine with big data applications. You use Python and R to do machine learning on the data sets. You have infinite storage, you have high-speed data processing. Finance is amazing these days because of those the technological advances. You have any coding capabilities, understand a lot of the mathematics and statistics. You understand data sets, you can work with large data sets, and then understand all the theories that are presented here. You'll be extremely valuable if that's the area that you want to go into. Probably have to couple it with a CFA, maybe an MS in data analytics, and then go on. If anybody really wants to go on and do something amazing, you would get an MS in financial engineering, where you're actually not only doing all the data analytics, but you're also designing the algorithms and using the statistical applications to identify these anomalies across all of the asset classes on a global basis. So figuring out arbitrage opportunities between Brazilian debt and Japanese, equities. It's like the ultimate Rubik's Cube, right, of potential combinations to create arbitrage, and that's what the private equity guys are doing. They're hiring PhDs in physics and data analytics with finance backgrounds to basically create these global arbitrage models, and then use the data and the models as proprietary intellectual property to then be able to raise capital from institutional investors or high net worth individuals. So they're basically black boxes. Okay. I think I have like 6 minutes. Pull out your statistical pretest and go to the modern portfolio theory in your pretest. And let's see if I can do this in like 6 minutes. So this is where I see some of the problems. Obviously, you have your portfolio standard deviation, you get your expected return on portfolio. Some people don't even take the risk-adjusted capital allocation line to the origin, which is the risk-free rate. And actually, it's pretty simple. For the next question underneath it, it just asks you what it would look like under a negative interest rate scenario. So if the risk-free rates are negative, then your efficient frontier the test question is, if risk-free rates turn negative, what happens to the expected return on the portfolio? If the risk-free rates go negative, what happens to the expected return on the portfolio? Goes down. Okay, that's it. That was basically the answer. And if expected returns on the portfolio go down, what happens to the value of the equities, or the value of the bonds, or the value of the real estate? Risk-free rates turn negative, what happens to the expected returns? They go down. Holding the growth rate constant, what happens to the value of the equities? You go up. So if you have global central banks printing trillions and trillions of dollars to basically buy up sovereign debt, driving up bond prices and driving down yields negative, what's it going to do to the expected returns on the equity portfolios? What's going to happen to the expected returns on the portfolio if the central banks print trillions of dollars and go out and buy trillions of dollars of sovereign debt, driving up bond prices and driving interest rates negative? What happens to the expected return? It goes down. And if the expected return goes down, what happens to the value of the equities? They go up. So they prop up the portfolio values by driving risk-free rates negative. Okay. This is your market basket. Right here. This is your utility curve. You should be writing these in these details. This is 100% stock. 100% bonds. I put dots here. Here, and I put dots in the middle. All of the portfolios on the efficient frontier and in the efficient frontier are actually feasible portfolios that can be constructed in the capital markets. Okay, if I want higher return and I'm willing to take on more risk, I'm going to sell off my bonds and I'm going to increase my allocation to stocks. Taking on more risk, I'm going to get a higher rate of return. And I like to see the ER stock, and I like to see the standard deviation P stock. So as much detail as you can put in as possible. If I don't like risk, and I want to avoid risk, and I'm willing to take less return, I can sell off my stock portfolio and start buying bonds and move down the efficient frontier. I can do that too. I can also jump off the efficient frontier up here and move up the capital allocation line by taking on leverage. In my stock portfolio, it's margin. In my real estate portfolio, it's going to be mortgage. I can also jump off the efficient frontier and move down the capital allocation line through the process of lending. And that's basically what banks do, through the process of lending. If I add alternative assets to my stock bond portfolio, real estate, insurance, alternative renewable energy, I don't think anybody got this right on the exam. It's the most important thing. If I add alternative assets to the portfolio whose returns have low, no, or negative correlation with stock and bond returns, the efficient frontier bows out. Bows out the efficient frontier. It reduces the portfolio return, but significantly reduces portfolio standard deviation. So at this point here, the expected return on the portfolio and the standard deviation of the portfolio, which is my risk-adjusted rate of return. If I add alternative assets to my stock bond portfolio, whose returns have low, no, or negative correlation with the stock and bond returns, my expected return on the portfolio is going to go down, but the risk or the standard deviation of the portfolio is going to go down even more, which means the risk-adjusted rate of return on the portfolio is going to go up. And if I'm managing a institutional portfolio or a portfolio for a family office or a high net worth individual, when that individual passes away, the insurance policies are injected into the estate and into the portfolio. And actually it increases the risk-adjusted rate of return, increases the return on the portfolio significantly, and actually puts the estate and the beneficiaries on a higher utility curve, which is where they wanted to be originally. There's no portfolios up here that we can construct in the universe. But through prudent application of insurance policies, when the principal dies, the death benefit goes into the portfolio, jacks the portfolio return, and the beneficiaries actually land on a higher utility curve, which is where they wanted to be originally.
And they can keep managing from there?
They're going to probably, well, they're going to get the wealth effect.
Okay.
They get the death benefit money. Okay? It's just all of a sudden you get cash into the portfolio, which jacks the return. Okay? So the bowing out of the efficient frontier and the wealth effect associated with the insurance is huge.
And it doesn't affect any of the rates?
It's just the return. Okay? And then the last piece of this puzzle, I think we're running out of time. There was one more piece that I wanted to, this is the last piece, you need to write this down. You can bow out the efficient frontier through diversification into alternative assets, but you can also bow out the efficient frontier through financial engineering, through the prudent application of derivative contracts. So I can also bow out the efficient frontier by writing forwards, writing futures, writing calls on futures, and buying puts on futures. I can also bow out the efficient frontier by selling short, writing calls, and buying puts on the ETFs and the stocks. So there's two ways of bowing out the efficient frontier and increasing the risk-adjusted rate of return. One is modern portfolio theory, which is basically diversification effects. The other is financial engineering, using derivatives as tools to apply portfolio insurance to basically mitigate the downside risk due to market factors in the portfolio. If I think that the values are going to go down and the returns are going to go down on the assets in my portfolio, I would be writing forwards, futures, calls on futures, buying puts on futures, selling short, writing calls and buying puts on the ETFs and the stocks. Okay, that's it. That's what I'm gonna go over. I didn't get to the technical stuff, but I'll take a look at your stuff. So I'm looking for the bowing out and that, and then the details, you know, the lines that go across.